In just over 2 years since the election, we have launched an unprecedented economic boom, a boom that has rarely been seen before. There's been nothing like it. We have created 5.3 million new jobs and, importantly, added 600,000 new manufacturing jobs, something which almost everyone said was impossible to do. But the fact is, we are just getting started.
That was President Trump's take on the U.S. economy during his State of the Union address last month. While it's true the economy still appears strong by some indicators, many experts continue to believe a new recession may be just around the corner. How likely is it, and how will it impact investors like you? It's time to tune out the hype and focus on the facts that matter to you, the income generation.
Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional-style investing to your portfolio.
I'm Jeff Small, guest hosting this week for David Scranton. Yes, there is data to support President Trump's claim of a strong economy from record low unemployment to solid GDP growth. But behind the strong data, there are also many warning signs that growth may stall and give way to the next recession. The recession model used by Wells Fargo shows the chances of a U.S. recession within 12 months rose just above 40% in January. And other forecast models put the odds even higher. But what are the warning signs? And why doesn't Wall Street seem to be worried about them? While the stock market is still down from its peak highs of 2018, last year's record, volatility has subsided and the market has trended mostly upward so far this year. We'll break it all down for you today with the help of our guest, financial writer and economy blogger, Logan Mota, along with Matthew Johnson, the owner and president of Johnson Wealth and Income Management in Iowa. First, let's do a quick review on what you should know about recessions and why there's increasing talk in the media among experts about the next one. As an Economics 101 professor might put it, a recession is when the economy stops growing and starts shrinking. It's really just that simple, but of course it isn't, because ultimately nothing about economics is simple. For example, some might say the indicator of a recession is when the gross domestic product declines for 2 consecutive quarters. But others, like the National Bureau of Economic Research, take a broader view. The Bureau defines a recession as a significant decline in economic activity that is widespread and lasts for several months. Their definition includes not only a shrinking GDP, but also a shrinking incomes, employment, industrial production, and retail sales. Historically, no 2 recessions are ever exactly alike. Some are long, some are short, some are targeted, while others impact virtually every aspect of the economy and cause lasting damage, like the last Great Recession of 2007 to 2009. Technically, a recession ends when growth returns, but that might not always be so easy to quantify. A politician's definition, for example, might be based strictly on GDP numbers, while an economist might say other factors should be considered, like employment and wage growth. Some have argued, for instance, that the Great Recession dragged on for far longer than a year and a half based on those other factors. Although GDP growth did go from negative 2.8% in 2009 to positive 2.5% in 2010, unemployment remained very high, real estate values extremely low, and wage growth has only really begun to rebound in the last 2 years. As for the stock market, if you're a regular viewer of this show, you may recall hearing David make the following point. that the Federal Reserve's efforts to jumpstart the economy with quantitative easing after the Great Recession only worked to create an asset recovery, but not a real economic recovery through artificial stimulus. That's why, as Dave has often pointed out, ever since the Great Recession and accompanying market crash, there's been an ongoing disconnect between stock market performance and economic fundamentals. Since 2009, the stock market indexes have grown by over 300%. Meanwhile, GDP growth struggled to hit or exceed 2% through most of those years, while again unemployment remained high and wages were stagnant. It begs the question, what's wrong with this picture? Now, as most people know, GDP growth did finally top 4% in the second quarter of 2008 and hit 3.4% in the third quarter. And at the same time, the unemployment numbers hit record lows last year, and wages and salaries finally jumped by 3.1%, the highest level in a decade. But, as most people also know, in the midst of all that economic growth, good news, the stock market experienced record levels of volatility in 2018, including two 10% corrections, and all the major indexes finished the year with losses. Again, what's wrong with this picture? Why is there a fundamental disconnect between what big investors seem to be thinking and what the economy is actually doing? You could argue we're seeing it again right now. In January, the extreme volatility died down, and the market actually grew by about 7%, even as experts were warning about the economic impact of the longest government shutdown in history. Part of the explanation, of course, is that the stock market doesn't really react to the current state of the economy. Its fluctuations are based on projections of future growth. As David often explains, Wall Street is driven by emotion, optimism, pessimism, fear, and greed. But why did investors seem so fearful in the midst of all that great economic news last year, and why have they seemed more hopeful this year despite increasing geopolitical uncertainty and growing concerns about a new recession? I'll talk more about that in just a bit, and about some of the specific issues fueling those concerns. But first, let's welcome our first guest, Logan Mota. He's a financial writer and blogger covering the U.S. economy and specializes in the housing market. You can find his work on Business Insider, Benzinga.com, and his own highly respected blog, The Financial Truth. Logan, thanks for joining us today.
Pleasure to be here.
You know, Logan, I've been doing some research on you, and you really are a student of the macroeconomic data. I've been to your website. You follow all the trends in the economy and housing. But the one question I have for you today, and I've got a series of questions, and I look forward to your answers. We see debt rising faster than GDP. How long can we keep up that pace?
We're going to keep up that pace for the rest of this century. I forecast federal debt going to $71 trillion by 2060. And I don't think it's going to be a problem if we allow most of the debt being transferred as transfer payments to older Americans.
Well, that's an interesting number. I will tell you, though, with the rise of the extreme right and the rise of the extreme left, the political economic spin will be, we can't spend the money or we can spend the money. How are we going to pay for all of that? I mean, are we going to be just putting up money continuously to do all of that? Because the budget shortfall would be enormous. That's 5 times the size of GDP practically. How can we pay for all that?
And we haven't been paying for it for a very long time. If you actually go back to many decades, federal debt has been rising, tax rates have been falling, and we've been borrowing at very low rates. So I think the benefit of the U.S. economy being the biggest economy in the world, having the biggest military, being the wealthiest nation in the world, we'll always get top notch in the bond market, and the U.S. dollar will never lose its currency. So we're just basically going to print our way to that $71 trillion of debt.
Well, I think you're probably right there, but I think if we go there to the $71 trillion number from the $22 trillion we're at now, excluding the Medicaid and Social Security liabilities we have, we're going to see 0% interest rates for a long time. We're going to be like a Japan model. Wouldn't you agree on that?
We are basically heading toward the Japan model. Japan's debt to GDP is actually 250%. So, and they have a dying population. We have prime age labor force growth for the rest of the century, not very strong like it used to be, but we have enough that's much better than China, Japan, or Europe. So our currency will stay the top notch for the rest of the century.
Well, fortunately, we don't have the secular demographic problem that Japan has because they're not procreating over there. Their population is dwindling, so they have a shrinking dynamic for their economy. All right, so on that note, what do you think is going to happen with interest rates in the short term? We see a flattening yield curve now. We saw it invert partially here. And do you think that's indicative of a recession?
No, and I stayed consistent with my calls over the last 6 years. I've said the 10-year yield will be between 1.6 and 3% majority of the time, and it has been. I don't think we can break away too much from 3%, especially with trillions of dollars of negative yields around the world out here. So unless oil prices really take off and stay up higher, which I don't think is a possibility anymore because our production levels are high, I think interest rates will stay low for a very long time unless we really create some domestic demand with domestic spending that creates wage inflation or companies really fighting over labor. So I think we could stay in a low interest rate for a very long time.
All right, well, I appreciate that insight, Logan. I think you're spot on. So tell me what's happening in the real estate market very quickly here. We've got about 30 seconds. What do you think is going to happen with real estate this year? Are we going to see declines or increases?
Existing home sales should be negative. There are going to be parts of the U.S. where you're going to see year-over-year declines in home prices. On an adjusted to inflation price level, we should have flat to negative prints on a year-over-year basis this year. But on a nominal basis, real estate should still be growing. I'm looking for total sales to be between about 5.6 to 5.8 million existing and new home sales together. So a down year in sales, but not too drastic.
All right, Logan, don't go away. We'll be back with more right after the break. I'm Jeff Small, and you're watching The Income Generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
So, with the U.S. in the midst of a great economic boom as President Trump describes it, why is recession such an increasingly hot topic in the media today? Well, as we discussed earlier, no two recessions are alike, and by the same token, the causes of a recession are never exactly the same. But there are certain trends and signs that historically have proven to be reliable recession indicators. Let's discuss a few that we're seeing right now. A number of analysts are talking about signs of weakness in the U.S. housing market as a possible red flag. The main concern has to do with the persistent decline in single-family housing authorizations, which some call a key predictor of economic recessions. According to a recent report by housing data provider BuildFacts, single-family authorizations declined year over year for their third consecutive month in January, falling nearly 3.5%. The trailing 3-month outlook from November to January also showed repeated declines, the report said. It further noted that these kinds of declines in single-family housing authorizations have consistently correlated with recessions since 1961. Housing maintenance and remodeling activity has also trended downward in the last 3 months, signaling a possible shift in consumer confidence. While these signs of weakness in the housing market are concerning, they aren't really surprising to many experts in light of several factors. With all of last year's market volatility, uncertainty over interest rates, concerns about the trade war, and other geopolitical fears, many Americans are feeling less inclined to make major financial decisions, including buying a house. The recent government shutdown only added to the growing air of uncertainty and highlighted a very troubling economic reality. That nearly 10 years after the last recession supposedly ended, many Americans are still living paycheck to paycheck. That's likely the result of several factors, some of which we've already talked about. They include long-term unemployment after the financial crisis, stagnant wages, and the fact that many Americans lost a significant portion of their savings when the stock market fell by nearly 60% from 2007 to 2009. In addition to the slumping housing market and waning consumer confidence, another recession indicator being discussed right now is the low unemployment rate. According to one study, since 1948, the economy has always entered or been in a recession when the unemployment rate increases 50 basis points from its previous low. With the current unemployment rate at about 4%, it is now 30 basis points from its most recent low and climbing. Experts describe this as another factor to watch closely, much like the even more concerning issue of an increasingly flat yield curve. As Dave has discussed often on this show, a flat yield curve is typically seen as one of the most reliable indicators of a coming recession. Currently, the U.S. economic yield curve is partially flat or inverted, and dangerously close to being completely flat. I'll talk more about the significance of this in just a bit. Another major factor driving recession fears right now is the idea that the economy is simply overdue for a downturn. The post-Great Recession recovery is now the second longest period of growth in the history of our country, and will be the longest if it continues in the next summer. If you're a regular viewer, you've certainly heard Dave discuss how the stock market is overdue for its next major correction. The same could well be said for the economy as a whole, since it's likely the stock market has been influenced by unprecedented levels of artificial stimulus approved by the Federal Reserve since the financial crisis. The result is an economy and stock market largely disconnected not only from each other, but from reality. Basically, it's all an illusion. What are the chances this illusion can continue indefinitely? I'll talk more about that in just a bit. Right now, let's welcome back financial writer and blogger Logan Mota. Logan, thank you for sticking around.
My pleasure.
So Logan, I take a Warren Buffett approach when I look at the real estate sector, and I kind of get a feel for what's going on locally and regionally in my area. And some odd numbers popped up recently when I did that. I found that listing expirations were up over 400% year over year, and we're in Florida in a great market. A lot of the home builders in the area were down 25% year over year in terms of what their revenues are. So I think the impact of the slowdown in real estate is much larger than anybody has yet to realize. And we saw that dynamic yesterday in the earnings numbers for Lowe's and Home Depot over the last couple of days when their earnings came out. I did speak on one of the major networks on that. But the reality is, I think real estate's going to slow down substantially more than anybody realizes. And so what do you think will happen on a worst case scenario with real estate? If it really slows down and consumer spending is truly falling off right now, we see a decline in restaurant purchases, unlike we've seen since 2008 and 2000, a decline in consumer spending during the holidays, everything seems to be basically stagnating or faltering. The consumers are pulling back. And so how big of a pullback do you think we're going to see with consumer spending across the board?
I think consumer spending is going to hold up fine. I think with real estate, what we already have, we actually have enough data to get a heads up of what we're going to look like in 2019. You could see that in the purchase application data. We're actually at cycle highs with the purchase application data on a year-over-year basis, but we do have some negative prints this year which we haven't had since 2014. But in 2014, when existing home sales ended the year at 4.9 million, we were actually down 20% year over year consistently. This year, we've had 4 positive prints and 3 negative prints. The positive prints have been higher in a percentage basis. So I think real estate's going to hold up, but I do think we're going to have, existing home sales stay between 4.9 million to about 5.3 million. So it will be a decline, but we ended the year last year at 5.34 million. So we might lose 100 to 200,000 home sales at worst.
So you don't think we're going to see a correction in real estate like we did in 2008 and 2009, I take it?
Absolutely not. What the big difference between this cycle and the previous cycle is this has been the weakest new home sales cycle ever recorded in U.S. history. And existing home sales, if you look at the sales and purchase applications, we're not even at 21st century levels yet. So it's very hard to have a bust when you don't have a boom. I think the peak sales rate for existing home sales in 2005 was about 7.2 million. The last print came in at 4.94. So it's really hard to have this crash when housing demographics is about to have its best boom in many decades in terms of we have a lot of people ages 25 to 31. While the housing institutions will call this a boom about to happen, I look at them as more as replacement buyers. So the demand will stay at bay for probably a decade here.
Huh. I kind of feel the same way. I don't see real estate correcting this time. I see it actually going up from here. I think if we're going to have a recession, it would be short-lived, and we might see maybe a 10% correction in real estate. The upper end priced real estate, like the homes are valued more than $750,000 to $1 million or more, those seem to be having great difficulty today. And so tell me what you're seeing in the higher end markets.
Yeah. That's exactly right. California is looking, it's going to have its worst sales year since 2008. Seattle is having problems on the higher end. New York is having problems. Those markets get a lot of attention, but they're just small parts. The entire U.S. as itself, you get away from the coasts where interest rates are right now, it's not that bad. Because adjusting to inflation, home prices aren't back to the peak levels yet. So in middle of America, it's parts of the South, even parts of the West and East, home prices with rates where they are not that bad. If we ever got to 5.875% on mortgage rates with what real home prices are right now, there I think would be a noticeable demand decline. But that's not in the card this year, and I don't think it'll be for next year either.
Okay, Logan, that was great info. Stay where you are. We'll be back for one more segment after this break.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Just how widespread are fears of a recession and a major market correction? Globally, according to a recent survey of over 800 CEOs by the Conference Board, business leaders say a recession is their #1 external concern for 2019. Meanwhile, threats to global trade and political instability ranked a second and a third. Recession fears were already brewing throughout 2018, but really ramped up in early December when the yield curve became partially inverted. That occurred when yields on the 2-year Treasury rate rose higher than yields on the 5-year Treasuries. A flat or inverted yield curve occurs where investor uncertainty pushes the yields on long-term Treasuries below those of short-term yields. It's harmful in part because it creates a disincentive for banks and other financial institutions to lend money. According to research by the San Francisco Fed, A flat yield curve has preceded every recession in America for the last 60 years, including the last 2. If you're a regular viewer, you know that David has been warning about the dangers of a flat yield curve since December of 2016. That's when the Fed first began raising short-term interest rates again after holding them to near zero for 7 years as part of quantitative easing. Dave's forecast that additional short-term rate increases would be problematic because long-term rates would eventually hit a resistance level, and so far that forecast has proven accurate. Although the yield on the 10-year Treasury rate did top 3% twice in 2018, it has not risen above 2.8% since late December, and it fell as low as 2.56% on January 3rd. With the Fed funds rate now at 2.5% following the last short-term rate hike in December, the yield curve is perilously close to being completely flat, and it's likely to remain that way as a variety of forces continue working to hold down long-term rates. It seems the Fed has finally accepted this reality as well, and at its January meeting, it amended its statement to remove language about further gradual rate increases. Originally, the Fed had planned on approving up to 3 more short-term rate increases in 2019. That seems unlikely now with the threat of a flat yield curve firmly in place, along with so many other recession warning signs. What's more, in addition to all the traditional red flags, some experts are arguing that the next recession may occur in a way that has no historical precedent. A recent Goldman Sachs report, for example, illustrates how America's next recession may be triggered by slowing global growth bleeding into the U.S. economy. The report argues that, quote, tighter economic and financial linkages today have likely increased the risk from foreign spillovers and presents several different scenarios for what such a spillover might look like. The scenarios are based on how global growth slowdowns of 1, 2, 3, and maybe even 4% would manifest themselves on the U.S. front. It argues that in a worst-case scenario of 4% global economic decline, the 2% U.S. GDP growth expected this year would shrink to zero, all but ushering in the next recession. Ultimately, Goldman Sachs' findings suggest that the U.S. is more at risk of a recession being triggered by a foreign slowdown than at any other time in history. That's especially troubling with so many unstable economic situations all over the world, particularly in Europe, where the potential fallout from Brexit continues to loom as a large unknown. Of course, there is always the possibility that the U.S. economy and stock market will defy the odds, and all the warning signs and continue chugging well into 2020 without a recession or even a major correction. Anything is possible. But if you're within 10 years of retirement, the important question is not what's possible, but what's probable. And if you believe the red flags and warning signs are too prevalent to ignore, what should you do about it? Now, let's welcome back financial writer and special guest and blogger, Logan Mota. Hey, Logan, thanks for sticking around.
Sounds good.
All right. So, in reality, we see debt across the board is larger than ever, especially consumer debt, corporate debt, federalized debt. It's not just domestic, it's global. We have this debt maximum that we're at. So how much more can debt expand inside of real estate before we come close to that tipping point that we did in 2007? What are the different areas that could potentially prevent a recession in that regard today?
Well, I actually disagree with the notion that consumer debt is a problem, because if you actually look at consumer debt adjusting to inflation, we're actually nowhere back to the previous peak. Majority of the debt is mortgage debt, and mortgage debt right now has never looked this good ever in terms of the quality of home buyers we have in this cycle, and the fact that we've taken off pretty much all exotic debt off the system now. So if you look at household debt versus incomes, we're basically at multi-decade lows. Fixed low debt costs against rising wages. So I'm not concerned about consumer debt in the way that some people have talked about over the years. Because if we look back in the last 8 or 9 years, people always talk about the student loan debt crisis, the auto loan debt crisis, the federal debt crisis. We've had a lot of crisis in this expansion, but what has happened is we have had the longest job expansion ever recorded in U.S. history. We're going to have soon the longest economic expansion ever recorded in U.S. history, with the highest job openings ever recorded in U.S. history. So consumer debt, if anything, it's not strong enough. And with our prime age labor force about to really kick in now, I think debt could expand more in a more modest fashion, and we should be fine there.
Wow. And that's exactly why I think real estate's going to go up. So if the recession's not going to impact home values at this point and the debt level isn't a concern, do you think now is a good time for people to buy homes for the first time, or maybe help their kids get into a house for the first time?
Housing to me is always the cost of shelter to your own capacity to own a debt. So I don't actually ever try to correlate it to an investment or should you buy a house. You're only going to be waking up and going to bed with that total mortgage payment every single day. So you, as a consumer, can only answer that question by yourself. Nobody on TV or a bank or anybody else can tell you that. So if you feel like that total payment and you can make it, and you obviously have to be qualified to even attempt to make that payment, you should be okay. But again, prices, have gone up a lot on a nominal basis. I think there's still some room left. But if you're concerned about home prices, just take a look at the monthly inventory. If monthly inventory starts to head towards 6 months on a national basis, home prices are, most likely going to go down in the following year. On an adjusting to inflation basis, especially if you're looking at the Case-Shiller index, we should see some flat to negative prints. But on a nominal basis, we still have some legs to go up higher right now. When the job loss recession happens, which is not going to happen in 2019, shouldn't happen in 2020 either, that'll create some distressed supply that will raise inventory. But it will be nothing like what we saw during the housing bust, because we actually have a lot of nested equity. There's no cash out boom. There's no recast concerns out there. This is the best home buyer profile we've ever seen in our lifetime. And 20 to 30% of the homes that were bought in the cycle were done with cash. So the amount of distressed sales coming in the next recession will be very small compared to what we saw in the previous cycle.
Yeah, but real estate is slowing down, Logan, because prices have peaked, interest rates are up, and consumers are pulling back and saying, you know what, I think I'm going to wait. It's a little too pricey for me, because homes really have, like you said earlier in the show, are up 50% since 2012. And so what other indicators, very quickly, Logan, besides the inventory report of 6 months, should consumers be wary of in looking at how real estate can be impacted by an economic slowdown?
Right now, there should be 2 indicators people should look at this stage of the economic cycles. That's leading economic indicators. It's forecasted every recession in the past 6 decades. Right now, it's flat. It's an indicator with 10 different categories in it. If leading economic indicators fall straight for 4 to 6 months, and housing starts fall within a year, that is a noticeable red flag for a recession. Both right now are not doing great, but they're not flagging a recession right now. So if you're concerned about a recession, I would just focus on those 2 data lines right now to keep it simple. And then, if you see declines year over year in leading economic indicators and housing starts, then we could start talking about a recession. But until then, this cycle could go on for another 2, 3, 4, 5 years until those 2 indicators actually start flashing a recession sign.
Logan Mota, thanks for joining us today. You can read Logan's blog, The Financial Truth, at loganmotashami.com. I'm Jeff Small, and you're watching The Income Generation. We'll be back right after the break.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
In late 2018, a JP Morgan survey found that 75% of ultra-high net worth investors said they believed a recession would hit by 2020, with a 21% of them predicting it would start in 2019. In addition to all the issues and warning signs we've discussed today, another concern cited by investors is the fact that corporations have now ingested all the profits from the Trump administration's corporate tax cut. At 15%, that cut certainly provided a boost, and it is probably the main reason the GDP topped 4% in the second quarter last year. But from the start, many economists argued the effects of that tax cut were like a temporary sugar rush and not sustainable. That means future growth is more dependent on individual tax cuts, which were only around 3 to 4%. What's more, with tax season now underway, many filers are finding that the rebates they counted on in past years are smaller or non-existent under the new Trump tax code. In fact, some are having to pay for the first time this year. As to how this might affect consumer spending in the months ahead remains to be seen, but it's hard to imagine it having a positive impact. Again though, so far this year, Wall Street has seemed oblivious to all these warning signs and to bad news in general, but that's unusual. As Dave pointed out on a recent episode, investors typically fall into a trend of shaking off bad news when a cyclical bull market period is nearing its end and a major correction is on the way. We saw it in 2007 when Wall Street ignored warning signs about the subprime mortgage crisis for over 7 months before starting its dramatic slide. The important thing to understand is that while there are many reliable signs and indicators, there's no one formula for how recessions and market corrections occur. The exact circumstances and ingredients are different every time. And as we discussed, we may see all new circumstances and ingredients come into play this time around. As Dave explained it on a recent episode, recessions and market downturns have many different causes and symptoms. And what we're seeing now are a lot of symptoms with the potential to become causes. For instance, sometimes the stock market drops because a recession occurs, and the sell-off is a symptom of the recession. But sometimes a volatile or tumbling stock market based on fears of stalling growth and a flattening yield curve can cause the recession, partly by creating the reverse wealth effect. Investors see their 401k shrinking and they feel less wealthy, so they cut way back on spending and the economy shrinks into a recession. In other words, sometimes the tail wags the dog until the dog starts wagging the tail. In the end, the how and why are less important than what you do or don't do, but you've got to protect your own financial future. Now let's welcome my special guest, Matthew Johnson, the owner and president of Johnson Wealth and Income Management, all the way from Iowa. He's been an advisor for more than 15 years. Matthew, thanks for joining us today on The Income Generation. It's great to see you.
It's a pleasure, sir. Glad to be back.
Glad you could sit in on the show today. You know, I've known you for a long time. You're a special man. I know you've got some unique talents and understanding what's happening in the markets and the economy. But tell us, based on the topics of today's show, how do you feel about the macro data, the large economic data, the potential for recession? What are you seeing in Iowa, and what are your thoughts?
Well, recessions are really important, and it's important to be able to spot a recession. But we know that we have recessions and recoveries that take place not only in secular bull markets, but also secular bear markets. But one of the bigger concerns that I have is really this. The government's not talking about this. Wall Street's not talking about this. The financial services industry isn't talking about this. The recession that I am most concerned about is the personal recession that's going to start happening to the baby boomer generation, the income generation. We call them the sandwich generation for a reason. They've put their kids through college, they're taking care of their parents, and they're hitting retirement, showing up with less savings and less money than they expected to have. Well, that could create a real recession, because if you show up on retirement's doorstep and you don't have the cash, you don't have the money to be able to retire, or what you think it's going to take to retire, all of a sudden you're going to start spending less. You're not going to be buying the luxury items. You're not going to be buying the cars and, that second home in Florida. It could create a real slowdown, but it's the reverse wealth effect, isn't it, that we're seeing?
It really is, and I like your terminology, personal recession, because a slowdown in the markets, a slowdown in interest rates affects the amount of money people are going to have. I think on the personal recession bit, with the market being at its all-time peaks again, it's going to be very hard for people to get economic expansion. So how do we deal with that, MJ? How do we overcome that?
Well, there's two ways that you get income when you're retired. You're either going to take and you're going to be selling assets, you're going to be selling shares, right? You're going to be selling things away in order to get money in exchange. Now, if the market stays high, that's not going to be a big deal, but we know that the market's not static. It doesn't always continue in one direction and go up. So what we've got to be able to do is we've got to make that transitional shift from income by selling now to income from interest and
Hold that thought. Matthew Johnson, don't go away. We'll be back with more here on The Income Generation right after the break. Welcome back. We're talking with Matthew Johnson, the owner and president of Johnson Wealth Management in Iowa. Matthew, thanks for sticking around.
Thanks so much, Steph.
You know, in our last segment, we were talking about the personal recession and the market being at the top end of the range and how people can actually get more growth. So why don't you keep the dialogue going on what you were digressing into about how people overcome the fact that they need growth in their portfolios, in their money, so they have a healthy retirement and they can create income. What should an investor do today in that scenario?
Sure. Well, the formula is really simple. Everybody wants total return. Everybody wants to grow the money, but we must understand that there's a couple of different ways that you can grow your money. You could go out and you could buy a stock and you can cross your fingers and toes in hopes that that stock goes up, right? But what if you started focusing on growing your money the old-fashioned way through interest and dividends? This is the old technology that the generation that lost everything to, you know, the Great Correction of 1929 learned over the course of 25 years. They learned that if their dollar earns them $1 of dividend, that's $1 of growth, right? So the idea of income production through my savings, if I'm able to take my savings and I'm able to invest it in such a way where I get interest and dividends steadily, very reliably, month after month, it's income that helps people successfully retire. The number one fear today when I meet with my clients is no longer that of dying. It's running out of money. And how do you run out of money? You run out of money by having to sell assets. And when those assets run out, you're done.
So you end up cannibalizing the resources.
Exactly. You're selling more and more assets and just hoping and crossing your fingers and toes that the market's going to continue to go up. What if your principal could remain intact? What if your principal could now generate interest and dividends and you could do what your parents and grandparents tried to teach you how to do, and that's to live off from the principal instead of on the principal. This is what I'm teaching my clients. This is what I'm seeing is the coming recession. People are, their advisors are not teaching them how to create income with what they've saved.
That's really a fundamental shift that investors have to make then to get out of the personal recession mode and the cannibalization of the resource when they decide to create income from their portfolio while they retire, either in their 60s, 70s, or 80s. And so what are some of the things that investors want to do today in your neck of the woods in Iowa? How are they feeling about the markets? They feel good? Are they optimistic? Are they pessimistic? Or is their radar spot on? How are investors feeling in Iowa right now?
Oh, there's a lot of different emotions. On one hand, they have this inbred sense that they need to be optimistic. They want to be optimistic, but their gut instinct is telling them, you know what, the market's too high. I need to make a risk reduction. And so they're searching for answers. They're trying to figure out, how do I do that effectively? Because they know the answer is this. They know what the answer is not. They know it's not putting the money in the bank.
It's the same in Florida. I think it's universal. All right, Matthew Johnson, thanks for joining us today. I'd like to thank all my guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers, and of course, my friend David Scranton for allowing me to be your host again today. Naturally, there is never only one viewpoint on any subject, and that includes today's topics. There are, in fact, some experts who reject the warning signs we've discussed and remain fairly optimistic about the U.S. economy and the stock market for the remainder of this year and beyond. And again, anything is possible. On the other hand, a far greater number of economists, market analysts, and even investors are increasingly concerned today. Concerned not only about the issues and warning signs we've discussed today, but other factors brewing beneath the surface of this so-called economic boom and Wall Street's recent return to optimism. If you've watched the income generation a few weeks ago when I hosted, you know that corporate debt is at record levels and that stock buybacks have helped further the disconnect between stock market performance and economic reality. Some experts see this as another major potential tipping point for the next market crash and recession. Others are concerned about the ever-increasing federal deficit and about the potential for more economic disasters like the government shutdown. Now that there's a power split in Washington, D.C., the bottom line is that eventually the economy and financial markets have to make fundamental sense again. Now that could happen by GDP growth continuing at 4% or greater for the next several years until real corporate revenue is finally caught up with the overinflated stock market values. Or it could happen in a way it usually does, with a sustained major stock market correction that realigns stock market values more closely with corporate revenue. And looking at all the evidence, ask yourself, which scenario seems more likely? More importantly, if you're within 10 years of retirement, ask yourself, with the market still fairly high even after all of last year's volatility, doesn't now seem like a smart time to reduce your risk exposure? Doesn't this seem like a good time to learn more about an alternative approach to saving and investing designed to generate income that you need to meet your goals and enjoy your retirement? Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it. I'm Jeff Small, in for David Scranton, and we'll see you next week.